Hello everyone. I did a project on forecasting one-year interest rates for the US Treasury yield curve. In my project, we did an analysis of US Treasury yield curve during the week of 18th March 2013 to 22nd March 2013. A major summary and highlights of what happened throughout the week. As you can see from the yield curve, the curve has flattened at the end of the week. The blue line represents the yield curve on Monday, March 18th, and the red line represents the yield curve from Friday, March 22nd. A summary. The 18-year bond rates up to which we forecasted our interest rates fell 5.8 basis points since market commencement on Monday to market close on Friday. The major events that affected throughout the week on the Treasury yields were: number one, the Euro crisis, the Cyprus bailout that increased demand for US safe haven treasuries, causing increase in prices and decrease in yields. The second event, and an important event, was the Federal Reserve press conference that took place on 28th of March. It announced lower than expected inflation levels, stable longer term inflation rates, and continued repurchase plan. All this put a downward pressure on the yield curve. Now let's do a day-by-day analysis of how each and every day event affected the yield curve. First, how the yield curve moved on Tuesday, March 19th. As you can see, there has been a significant dip in the yield curve from Monday, March 18th to Tuesday, March 19th. In fact, the yield curve saw its largest dip of the week, with 18-year rates of 2.711% on March 18th down to 2.653% in March 19th. Overall, a 5.8 basis decline in 18-year rates compared to the previous day. According to Bloomberg, Treasuries gained for a third day on March 19th, pushing 10-year note yields to a 2-week low, as investors sought refuge on concern that turmoil over bailout on Cyprus will worsen Europe's sovereign debt crisis. It's more about uncertainty, as Paul Ashworth, chief US economist at Capital Economics, who showed concerns over Europe and how people are fluctuating their investments from Europe to United States and United States to Europe amid all these news coming from Europe. A further drop as the Federal Reserve started a 2-day meeting amid speculation that policymakers will decide to keep buying bonds to spur economic growth. This put a downward pressure too, and the 2-10 spread fell to 1.658% from 1.698% the previous day. Let's see how events took place on Wednesday, March 22nd compared to March 19th. Compared to March 19th, we can see a steepening of the yield curve on Wednesday, March 22nd. The red line, which represents Wednesday, is above the blue line. The yield curve steepened, and the major news driving the steepening was positive news coming from European Central Union, which assured to provide liquidity to Cyprus. So this was a news that happened early in the morning, and the yield curve actually steepened. The yields went up and the prices went down. However, the big focus of the day was the Federal Operations Market Committee press conference by President Brent Bernanke. The yield has been high as 1.98% for 10-year bonds earlier, but fell to around 1.93% after the Fed statement. So let's see what happened in the Fed statement that resulted in a falling of the bond rates. The highlights of the Fed press release and the possible impact on inflation. The Fed said there hasn't been much change in inflation, lower than expected short-term inflation, and stable longer-term inflation. If people believe in the Fed, the yield curve has to flatten. And if people believe that the Fed is just puffing, they might not believe in the Fed, and the yield curve might steepen, indicating a compensation for inflation. The repurchase plan, not much of a change. As per Fed, they will still continue buying mortgage-backed securities and longer-term treasury securities. Both will actually put a downward pressure on securities. The federal funds rate, the unemployment and economy, they give a hint on how the economy is doing. Overall, it's doing good, but as per them, they need to have the unemployment level above 6.5% to stop doing any market operations. Let's see what happened on Thursday, March 22nd. The yield curve from Wednesday to March 22nd. Actually, the treasuries gained on Thursday, pushing yields a little lower. So this actually overturned a little bit of steepening that happened the previous day. the 10-year and 18-year Treasury bond yields slid 2 basis points and 1.1 basis points respectively. Still uncertainty on the Cyprus bailout. People, however, have showed confidence on the Fed, observing at how the Treasury yield acted in a couple of days. Thursday, March 21st to Friday, March 22nd, we see a little bit flattening of the curve to indicate that it has been a week that has been mostly dominated by flattening of the yield curve. Treasury showed steady movement throughout the day though. Market grew more optimistic about Cyprus's ability to raise funds to secure the bailout money. According to MarketWatch.com, some investors were betting that Cyprus will come up with an effective plan before Monday to secure its financial package, so that would diminish the appeal of safe haven assets, and once Cyprus is doing good, the appeal and the bond yields for treasuries are going to go up. So we calculated the 1-year forecasted interest rate movements using the using the unbiased hypothesis, which we can see over here is the 1-year forecasted interest rates are moving as the treasury yield is moving. If the treasury yields are going up, the forecasted rates are going up, and vice versa. The major bumps we could see in the 10-year and 8-year, the 10-year and the 18-year treasuries, where we can see a lot of volatility. So this is just what I repeated on the slide before. And the conclusion, it's been an eventful week. Treasuries yield curve flattened, and the major events were Cyprus crisis and the FOMC meeting. Thank you so much.